Alright guys, so the numbers are out and it's official. Germany is the worst performing economy in the developed world. Their GDP has contracted in 2023. The moment interest rates started going up plus Berlin cutting away from cheap Russian energy, this was coming, we all knew it. This is the effect of deindustrialization. It's a complete disaster for Olaf Scholz. Exactly a year ago, he told the world that Germany would not fall into a recession, but his prediction is about to collapse on itself, and it's very likely his time as Chancellor of Germany is coming to an end. In our lead story today, Germany was the worst performing major economy in 2023. Rising rates and high energy costs contributed to a 0.3% contraction in Q4 GDP. Because the leverage of cheap Russian gas is gone, German industries are no longer competitive. Costs are piling up, which trickles down to the cost of products as well. Understand the state of the economy today, right? We are in a global slowdown where money is becoming very expensive. People can't afford to spend on German made goods, especially when there are cheaper products out there of the same or even superior quality. If you're going for an EV, it doesn't really make sense to buy one in Germany or Europe. You'll be paying over 65,000 euros for one. If you go for the Chinese product, it's only around 31,000 euros. That's more than 50% off the price tag. So foreign demand is dropping, and because interest rates are higher coupled with soaring inflation, people in Germany are also consuming less. It's a double whammy that has pushed Germany to the edge. One leg is already in the recession coffin. Households' consumption fell by 0.8% last year, taking it 1.5% below the pre-lockdown levels. People are spending less because real wages are still collapsing. Germans are working more, but their buying power isn't keeping pace. But this next part is crucial. The gross value added of the German industry contracted by 2% last year. In other words, the true collapse is coming from manufacturing. A lot of companies in Germany are seeing the writing on the wall and they are all jumping ship. They are heading to China where energy is cheap plus a huge market to sell to. They are also fleeing to the US where there are a ton of subsidies for companies. Germany's industry is not looking good. Factory orders are coming down fast and industrial production has been dropping in tandem. Since June last year, it has been contraction after contraction, with a big drop of nearly 5% in November. I find it incredulous that even till today, we have mainstream media trying to spin the narrative. It's all about how Germany has dodged a recession and is about to make some heroic comeback. But that is some next level BS that we have to dispel. The months and the years ahead are still going to be tough. The energy crisis still isn't resolved, and we have the Middle East situation about to get worse. From Bloomberg, Germany narrowly escapes recession, and this year's rebound is said to be shallower than elsewhere. We need to go beyond this headline. The economy is still walking the plank, and there's likely no escape this year. Germany's Q4 came in at minus 0.3%. But do you know why it didn't lead to a recession? Because they revised the Q3 GDP upwards to 0%. Originally, it was minus 0.1%, but it was suddenly revised up by a positive 0.1%. Makes you kind of wonder what's going on behind the scenes. But don't get it twisted, GDP fell by 0.3% last year, so a contraction has happened over the past 12 months. According to Germany's BDI forecast, they expect the economy to grow by 0.3% in 2024. But I want to challenge that. I think they are wrong. German manufacturing isn't the only industry that's collapsing. Another critical sector is struggling. So if you're living in Germany, you are going through a trifecta of economic pain. Real wages are going down, your job security is in question, and interest rates are higher than before. The last thing on your mind is buying a new home, and that might be the next domino about to fall. German housing slump makes builders more pessimistic than ever. Sentiment in housing construction has dropped to record lows. Cancellations are up, orders are also starting to dwindle down. Housing makes up 7% of Germany's GDP. That's a significant amount of the economy that's also starting to contract. You throw in this together with German manufacturing, it's really doom and gloom. Over 22% of builders are complaining of cancelled projects. Nearly 57% of builders are suffering from a lack of new orders. People just aren't buying homes. The last thing you want is to be stuck with a 10-year mortgage where rates are 3 to 4% higher today. And this is hitting demand hard. Home prices are starting to drop fast. Just in Q3 alone, German residential homes have crashed by 10.2% in value. China isn't the only economy that has a property crisis going on. It's just more publicized on mainstream media. If Germany is to recover, they need to solve two big problems. The first is to find cheap alternative for their energy crisis. But at this point in time, with the Middle East and the Red Sea crisis, that is almost impossible. Now, the second depends on the ECB. Berlin needs interest rates cuts or the slump will continue to get worse and worse. Interest rates coming down will ease the pressure on the mortgage market and give manufacturers more breathing room, right? They can lower prices and borrowing costs won't drive them off a cliff. But I have bad news. The market predicts four cuts this year, but the ECB is warning that it might not happen. It is very possible for zero cuts to happen in 2024. Headline inflation has rebounded back to 2.9% in December. It is up by 0.5%, so the data isn't convincing enough. And that's why I'm still bearish on the German economy. It's very likely that in Q1 this year, GDP will be negative. There will be a textbook recession unless, of course, they decide to revise the GDP numbers up again. But you can't run from the truth forever. Now, while the German economy is sinking, the global south is thriving, specifically Russia and China. Over the past 2 years, we have seen the G7 cut away trade with Russia. They have also decoupled fast or they're decoupling fast with China. To counter this, Putin and Xi Jinping, they are working together like never before. After all the sanctions and oil price caps, the Russian economy isn't collapsing yet. According to Rostat, their GDP has printed a 5.5% GDP growth for Q3 last year. This was after shrinking by 3.5% in the same quarter in 2022. Now, part of this is because of Russia's war economy. Weapons production does increase economic growth, but a bigger reason is that the world is still buying Russian exports. If we track 2 years of Russian crude export value, the revenues earned hasn't really changed at all. Even after the price cap was introduced back in 2022, exports were still sold above $60 when global crude prices went up. We are at the same level as 24 months back. It's as if the conflict never even took place. This is further evidence that the sanctions aren't working well. India is still buying Russian oil. Europe is still buying Russian LNG. But their biggest partner is China. China-Russia trade has reached a new historic level which has big implications for the global economy. And we need to talk about this. Trade between China and Russia has risen to a record $240 billion last year. Putin was aiming for just 200 billion, but the numbers has exceeded all expectations. Chinese shipments to Russia jumped by nearly 47%, while imports from Russia rose by 13%. So China is importing more Russian oil and gas, while Moscow is buying more finished goods from Beijing. And that's why we need to see both countries as one unified economic bloc. There's no reconciliation coming between Russia and the West. China and the US are also waging a silent economic war. Now, if we focus on Chinese exports to Russia, the majority of goods being sold are machinery and cars. Because of the West pulling away from the Russian markets, it has opened the door fully for Chinese goods to flood in. It's a fivefold increase over the last 6 years. China, on the other hand, relies heavily on Moscow for oil and gas imports. We'll see this continue to stay high or even trend up in the future. And here's the problem for the West. Over 90% of Russia-China trade is done outside of the US dollar. And this obviously has big implications. Firstly, there will be lesser need for China to hold US bonds to finance their trade, and more of Russia's trade surplus will either flow into their war chest or be rolled over into Chinese bonds or gold. And either way, guys, this isn't good for the Western financial system. The more Russia and China trades with each other, the more they sanction proofs themselves. And this is important for Russia, but even more critical for China. Because there's the de-risking away from the West, China needs to rely more on the global south to grow their economy. During the Davos summit, China announced their GDP growing by 5.2% in 2023, beating all expectations. But here's the key part. China didn't resort to massive stimulus to fund this growth. This is the big difference compared to the US. The US economy is being driven more by deficit spending, while China is focusing on expanding trading relations. Increasing their trade with Russia is going to be a key strategy for Beijing, and it won't be long before the bulk of China's international trade is done away from the US dollar. China's biggest weapon isn't really their military, but their economy. But let's shift gears and talk about the Federal Reserve for a moment. Something big is about to happen. Jerome Powell might be ending the Fed's quantitative tightening or QT program really soon. And if you didn't know yet, the Fed has been selling off their balance sheet to drain money away from the financial system. They are removing all the excess liquidity that they printed back in 2020. Since September 2022, the Federal Reserve have been selling off nearly 100 billion in government debt every single month. 60 billion of US Treasury bonds and 35 billion in mortgage debt. That is a tremendous amount of money being pulled away from the financial system. The Fed has reduced its balance sheet by over $1.2 trillion. It went from nearly $9 trillion down to 7.7 trillion over the past 18 months. Remember what the Fed bond sales mean. When the Federal Reserve buys bonds, they create money out of thin air to purchase them. Conversely, when they sell bonds, money in the system simply gets erased. It disappears and vanishes into the matrix. To put it simply, it's just a magic trick. So $1.2 trillion have vanished from the US financial system. Then you have to throw in another important fact. The US Treasury has been selling a ton of bonds. The national debt, in fact, has gone past $34 trillion just last week. To finance US government spending, our best friend in the world, Janet Yellen, has been pulling money away from the real economy into US Treasuries. And this big drain in liquidity can be seen immediately in money market funds. For Bloomberg, money market fund assets climbed to all-time highs. Nearly 6 trillion is sitting in US government bonds, and that's just on the short end. We're not even talking about the 10-20-year bonds as well. That's money outside of the banks, which means fewer dollars circulating in the real economy. In other words, a big liquidity crisis is coming. And this is where Wall Street, especially JP Morgan, is predicting that the Federal Reserve is trapped. They have to end QT soon or the US economy will have a big credit crunch. And here's the report from JPM titled, "It's all over now, QT." They expect the FOMC to announce in January or February an end to quantitative tightening. Starting in April, the Fed will be selling significantly fewer Treasury bonds from their balance sheet. And by November this year, QT will be completely over. There will be no more selling off the balance sheet. And it kind of makes complete sense. The Fed has been back into a corner where selling more bonds is becoming impossible. Now, firstly, there's no room for fiscal policy to maneuver anymore. In other words, the US government has to keep borrowing money to prop up the economy and fund two wars, right? Remember, the Ukraine conflict isn't over, and things in the Middle East, they are getting progressively worse every single day. Just in December alone, the US budget deficit has gone up by 52% to nearly $130 billion. Biden wants to keep the GDP numbers looking really good, really high, and this is pushing the Fed to do the unthinkable. Yellen will be issuing more bonds, and if the Federal Reserve doesn't stop their QT, two disasters will happen. In the short term, we could have a liquidity crisis that triggers a recession, and in the long term, it keeps bond yields higher, which pushes the US national debt closer and closer towards default. But if the Fed stops QT, it's basically an admission that the economy is on the edge of a cliff, and it won't be long before the Fed primes the money printers once again for the next QE program to happen. US banks are already sitting on a huge pile of bond losses. We are talking about nearly $700 billion underwater across all securities. The banks are still in crisis mode. It's just swept under the rug because everyone is all focused on Ukraine and the Middle East. The longer the Fed continues QT, this is going to delete money away from the system. Not forgetting that Janet Yellen is draining money by issuing more bonds at the same time. The banks are getting squeezed and their reserves are in jeopardy. They need Jerome Powell to step in. So it's just a matter of time before the Fed U-turns and stops selling. And if the economy collapses, the Fed will have room to print money once again. They have the ultimate excuse. We'll be back to QE once again. And this also means that the Fed's goal of 2% might never ever come. Since July last year, inflation has hardly moved. CPI has rebounded up to 3.4%, and core inflation is stuck near 4%, double that of the Fed's target. Should the US economy collapse, the Fed will have to choose. It's either to allow a full implosion of everything or print money to save the system. But that will also mean 2% inflation would be impossible. So the end game is still going to be very inflationary. Prices will continue to trend higher. And if a recession happens, I don't think it will be for long. The Fed will likely relaunch QE once again to prop up this zombie economy. But let me know what you think in the comments below. Can the German economy recover from this? And more importantly, will the Federal Reserve stop their QT program this year? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.